We're live. It takes a second. And we are live. All right. So we want to welcome everybody to another week of Find My Way Home Live. And I'm really excited today. We have two of our experts from the Find My Way Home Expert Network here. We have Mia Schultz and we have Chad Rankin. And today's topic is how much down payment do I need? And this is a really common question. It's in the description here. I put everybody knows you need 20% down, and everybody is wrong, right? It's like we have these conversations all the time, and they're like, well, I don't have my 10% down. So that's our conversation that we're going to have today. But what I want to start with is Mia, why don't you kind of introduce yourself, tell us a little bit about your experience and why this is an important topic for you. And it's all you.
Hi, everybody. Thanks for joining us on Facebook today. I am Mia Schultz, and the company I work with is Geneva Financial. And I've been known Scott since about 2013. We go way back when he was just building Find My Way Home and into what it is today. And we have a purpose out there to help answer all the questions that everybody has about getting mortgages. And Find My Way Home has grown so big because there's not a lot of loan officers out there who are given the answers straight or even know the guidelines straight the way that Scott puts it out there. So really glad to be a part of Find My Way Home. I have been doing loans for about 15 years and love every minute of it. Most of our people are first-time home buyers, and when they're coming in the door, they don't know, they know a little bit. And I'm here, as well as the rest of the Find My Way Home experts, to help everybody navigate through all of the guidelines. And the one that we're talking about today, obviously, is the down payment portion and the misconception that you need 20% down or even 10% down. There are many programs out there that can help you in many different ways so that you don't have to wait that whole time saving up that kind of big chunk of money.
I'm just shocked that you started doing loans when you were 12.
Right?
Like that's amazing. That's amazing to me.
Thank you for that. I was a wee little girl, right?
Scott, she's a married woman. Save your test lines for the Joe Rogan show this weekend. The bar scene in Austin is going wild. This guy's just throwing them out left and right.
Oh my God.
Well, you know, and Mia, you said something also that's important is there's a lot of, you know, in our inner circles, we're known as guideline geeks, right? Like we're the people that don't give up, and we dive into the guidelines and we solve these problems. And the reason we started Find My Way Home is not because there's not a lot of us out there, but it's hard to find on a Google search.
Right.
You end up getting stuck with, you know, these big box lenders and these call centers. And so that's why we're trying to bring some of the smartest folks I've ever met together onto this network. So Chad, welcome again. This is a perfect topic for you. Why don't you introduce yourself and tell us a little bit more about what you do?
Sure thing. My name is Chad Rankin. I, like me, have been in the business for approximately 15 years. And I have, ever since I really began, I first got into the business focusing on refinances during the 2008-9 meltdown, tried to help keep homeowners in homes. But after that, in 2013, really started to focus 100% of my priority on getting, you know, first-time home buyers into homes. I just believe deeply in the American dream and really what it does for families and for their generations thereafter. Security, stability, community involvement, etc. I mean, the data is very clear and straightforward as to, you know, historically the income and the assets that a homeowner has versus somebody that does not own a home. So in my area, I'm out of Worcester, Massachusetts. It's a real melting pot. It's a great area that I really enjoy. I've had the pleasure of working with, families from over 60 countries buy homes as hardworking immigrants. So that's really cool. And of course, not only immigrants, but that's just, with that being said, we're working with a lot of times folks that have two jobs, per diem income or variable income, et cetera. And it's a lot trickier. You really got to make sure that you've done your due diligence. You've got upfront upfront verifications of employment written many times by the employer. I need to know whether or not, and I won't get too technical, but whether or not I can take a 2 year plus year to date, 1 year plus year to date, or year to date. We have to take the lesser of those in that kind of variable income scenario. And there's, we could all talk for hours about all these different types of scenarios. So I was never afraid of that challenge. In fact, it excited me to be able to figure this out, whereas the other guy couldn't, that declined them, or the local credit union like we have here that people get declined all the time. And then they speak to somebody in their community and they say, well, you got to go down the street, speak to Chad or the Rankin mortgage team. And my team members have been, trained and, and have learned under me to realize these things when we see them as well, and to dig deep and to look outside of the box and ask questions. And so we just we enjoy that part of it. We enjoy helping people that would not have been helped otherwise. Like you said, Scott, especially with these big box, retail lenders, kids in cubicles that just don't know specific guidelines or state guidelines.
Yeah.
So that's what we specialize in.
Well, Bennett, you're the right person for this conversation. Josh, you want to kick us off here? And
yeah, let's jump in. And what we specifically wanted to address tonight is one of the biggest misconceptions. Anytime potential home buyers are polled, one of the biggest misconceptions they have is that 20% down payment is required, or that if it's not required, that there's a big penalty or a big expense, or that mortgage insurance is a horrible and awful thing to be avoided. So we're going to go through a number of options for getting in with as little as 0 down, 3.5% down, and everywhere in between there and 20%. It would be wonderful if we lived in a world where with $500,000 and $600,000 and $700,000 entry level homes that people could save up 20%, but for most people that's not realistic. So the good news is we've got a ton of really good options, and we've got 3 really good loan originators here to walk us through exactly what that looks like. So Scott, I think we kind of wanted to start with let's get the 0 down options out of the way. I'll kick it off with VA. VA is unique. It's an awesome loan program, and unless you are a veteran who actually served, you're not going to be eligible. But if you are eligible for a VA loan, truly 0 down financing, 100% loan, you pay no monthly mortgage insurance. The way that the loan is insured, so to speak, is there's an upfront VA funding fee that's financed into your loan. You don't pay anything out of pocket, and that funding fee goes to the VA to pay for the very small percentage of VA loans that end up in default. So it's a great program. They have one of the lowest default rates. They have some of the greatest flexibilities, and the biggest of those is a 0 down payment. So if you're a veteran, you already know you're eligible for this. You probably know most of the details, but that's an easy button. So Scott, do you want to kind of talk a little bit about USDA loans? I know you have a little more experience than I do with that, but Mia, Chad, you guys have any experience with USDA, one of our other big 0 down options?
USDA is an incredible product. It's very specific, obviously, to the rural areas, and there are websites that anybody can jump on to see if your area is eligible. And if you fit that income guideline and you fit that area guideline, it's a great product with 0% down as well. It does have a little bit of PMI, which is a little bit different than the VA side.
Do they also have an upfront premium, Mia?
On the USDA, I don't believe they have an upfront. Is that right, Scott?
I believe there's a guarantee fee. So we're in California. Josh and I were in California.
There's like 5 houses left in California that qualify for USDA financing.
I have done a couple of them. I do believe there didn't used to be an upfront, but there now is an upfront. I believe it's like a 0.5%, and then there's a very small monthly mortgage insurance similar to FHA, but much less than FHA. One of the interesting things about USDA that I like to point out, though, is it doesn't have to be a farm. So it's not rural property; it's residential property in census tracts that have lower population. And like what Mia said, there's a map. You put in your address and it'll tell you whether you're in a USDA area or not. I have literally seen one USDA eligible home on a street, and then on the other side of the street that it's USDA eligible. So there's not a whole lot of rhyme or reason. It's kind of like census tracts, and you just type in USDA map or USDA eligibility on Google, and you will find it. The next one is a super common one, and I kind of wanted to tackle this one first because, you know, one of the reasons why we put the Find My Way Home Expert Network together is because inexperienced and call center lenders don't have vast product knowledge. And if you say first-time buyer, they think FHA loan, 3.5% down, and that's kind of where they stop. FHA is an amazing first-time buyer program. Chad, you want to kind of go into the details of FHA and what makes that so great?
Sure. So FHA is typically a good product for a lot of folks that really haven't grown up with credit education, and or sometimes single buyers that need a higher debt to income ratio allowance, which FHA allows, a higher back end debt to income ratio, which is the combination of all debts that currently report the minimum monthly payments to the credit bureau plus your anticipated minimum monthly payment for the mortgage. So there's a few reasons that FHA is many times the right choice. You can go down to a much lower FICO, even down into the low 500s, but that requires a 10% down payment if you're under 580. But still, somebody theoretically with a 585 FICO, if it pops approved in FHA's decision engine, then they can theoretically buy as little as 3.5%. And there would be no other option on the table, not conventional, et cetera, other than VA, of course, but we already spoke about that. So there's other intricacies where they can, for example, an FHA with 2 units, there's no reserves. There's different technicalities and different reasons that you would choose it. But it does, for me, for example, probably equate to 40% of our lending, because many more people fit in this bucket than do other buckets.
Yeah, at 3.5% down with the credit score and debt flexibilities, FHA is a fantastic program. These next couple of programs that I want to dive into.
Mia was going to say something, Scott.
Oh, go ahead.
I was about the FHA. One thing I think over the years or previously in the past that FHA started getting a bad stigma, thinking that these were not good loans to have. And I would just want people to know out there that FHA is actually a fantastic product, especially as guidelines change and things move around where conventional loans are a little bit tougher to get. FHA is so much more lenient with the credit scores, so much more lenient with debt ratios, and allows more people to be home buyers that are good people, that are good qualified people still. And just wanted to get through that a little bit because of the stigma that I hear people still holding on to, which I think was a very old thought.
I'll add to that briefly too, because it's very important, because like I said, sometimes it's somebody that had to go as high as a 56.99 back end debt to income ratio. They might have an 800 FICO credit score.
Right.
And we see that. or they don't have any reserves for a multifamily 2-unit, for example. And so it's very true. And sometimes there's households that have 2 wage earners, but one can't be on it for one reason or another, or they just went through COVID and they're a restaurant owner and they didn't make a lot of money. And there's many, many reasons why you could have a second person in that household that may be contributing that can't be on that mortgage. And so you've got one individual that looks on paper to have a higher debt to income ratio, but in reality, there's a lot more household income. They got a high FICO. So definitely, you're correct, Mia. It's got a bad stigma sometimes, incorrectly so. And I forget, I haven't seen the data recently, but the actual, I know that VA is, excellent. Like there's very few folks that end up, losing their homes to foreclosure or anything like that. But the statistics for FHA is pretty darn good too. So there's a lot of, misinformation out there, and even in the real estate community.
I want to kind of wrap up the FHA piece with this. You've kind of heard here, pro, con, this sort of back and forth. I always like to start the conversation with FHA loan. Is it awesome or is it awful? Because everyone comes to me with an opinion. No one goes, hey, I've never really heard about this FHA thing. Tell me about it. It's, oh, whatever you do, I don't want an FHA loan. I've been told those are terrible. Or they'll come and say, I only qualify FHA. I heard they're awesome. Let's do it. And I have an example right now of a client that we're working with that ended up going FHA that is enabling them to do something they otherwise wouldn't have been able to do. And it's sort of indicative of the flexibility. So Chad hinted at a number of flexibilities. But in this example, they just sold their house. They have the ability to put 20% down. Income was down due to an illness, so debt to income ratio was high, and they had to make a choice where they could either go with a lower priced home, sort of sacrifice on the home and make it more likely that they would need to sell and move again and relocate in the future. Or when we run the numbers with an FHA, even though they put 15% down FHA, they were able to get in, keep $50,000 or $60,000 to do the improvements to their home, and they had a slightly low credit score, just a hair over 680, which for a conventional loan, you're going to pay higher mortgage insurance, slightly higher interest rate, and a 680 is a great score for FHA. So when we looked at the two options, the payments were the same. It allowed them to keep some money back, and it allowed them to go to a $650,000 house or $680,000 that they weren't going to be able to buy if we didn't go FHA. So sort of wrapping a bow around that, don't let anyone tell you FHA is amazing, you have to go FHA, or FHA is awful, never go FHA. Numbers never lie. Talk to an expert, have them pencil out both and show you. Don't ever let anyone tell you, okay, I ran the numbers, FHA is the right answer for you, or conventional is the right answer for you. I ran the numbers. Here's the comparison. Here's what's good about FHA. Here's what's good about conventional. Which do you think is better for your needs? Because I had never have a client go, oh shit, I don't know, please tell me. They look and they go, oh, I like that one. So at least that way you have the peace of mind of knowing you worked with an expert, ran the numbers, showed you, and let you make the decision of what's right for you and your family.
Right.
Excellent. All right, so these next ones are kind of fun, and a lot of people, I think these get missed by a lot of inexperienced loan officers. They're also, like Josh, we don't run into a lot of these in California because there are certain restrictions on some of these programs, but these are really good programs. And I know, Chad, you do, Chad and Mia, you do a bunch of these. Which one of you would like to? Well, Mia, why don't you start with the Home Ready with 3% down and tell us a little bit about that program.
So this is my baby. I love the Home Ready product for a lot of my first time home buyers. It is income driven. So you do have to qualify by income, and does allow you to get in for 3% down. I think we touched on earlier that a lot of these programs, when you do put less down, and we can get deeper into the PMI piece later, but you're going to pay a private mortgage insurance for using this. But when you combine it with Home Ready, the mortgage insurance is even less on that. So we can take people and who may have been thinking that they had to put 5 or 10% down, or even 3.5% on the FHA side, and paying that monthly mortgage insurance. We could flip them to a Fannie Mae Home Ready loan, buy out their PMI, and save them tons of money on their monthly cash flow. It's a very cool product.
There's another cool thing about this product is the loan level price adjustments, right?
Yes.
So on conventional mortgages, why don't you explain that piece a little bit, because that's a really big deal with this program.
The LLPAs are capped. So in a normal scenario, if you're not using Home Ready, you're going straight Fannie Mae, your interest rate is adjusted based on how much money you're putting down and where your credit score is. So there's a scale, and it goes up and up and up. When you use the Home Ready plan, you're going to be capped not to exceed X amount. I don't know what the actual points are where they cap it, but they cap it at, I think, a 10% level.
I thought it was like 1.5 or
1.5. So 10%, it's about, it equates to where 10% down payment would be. I think that's kind of where it caps out. But you don't get hit for that, which means that you can do a Home Ready loan and have a 3% down payment, and your interest rate is not going up because of that. So you're actually getting a lower interest rate for that product because we're using the Home Ready.
Yeah. So this next program, Chad, why don't you talk about this? Fannie Mae is the only one. So the thing you need to know about Home Ready is those income limits. So the income limits are a little bit aggressive. They used to be a lot looser. You could go a little bit higher. But Fannie Mae came out with a program, Chad, this was it wasn't too long ago, right? I mean, it's a relatively new program. And they call it their standard 97. And I think you're actually helping a couple of homeowners with this program right now, right?
Correct. And I actually really just did a training with my team members, my two licensed loan partners, because we focus so heavily here in Massachusetts with Mass Housing, which is a state housing program. And so we don't do as much of the Home Ready and Home Possible programs because the state housing actually offers a higher income limit. But when, let's say, for example, Worcester County is $101,200 for whoever the applicants are on the application. Both of these folks that we're working with right now, two separate applications that are both under contract, they both make over $101,000. So young lady was making $40,000, $50,000, got a great job. I mean, she bumped her income up to literally $106,000 a year after coming out of maternity leave and working per diem and so forth. And now, like overnight, like she doesn't qualify for that product. And the only product that really makes sense for her is the Fannie 97 program because there's no income limits. A very similar scenario, on the other one where she recently got a $15,000 raise and it bumped her out of Mass Housing into Fannie 97. So it's a great product for the right people. Most people don't need it, and if somebody's going conventional, if they've got 5% down, it might be. We'll talk more about conventional, obviously, but they might want to try to go that because with the Fannie 97, there are LLPAs for the lower down payment, and that will impact potentially rate as well as PMI. So this is a great program for somebody that only has 3% and they make more money than go with like a Home Ready that Mia was speaking about,
and probably a higher FICO score.
Did you mention, and I didn't hear, the only stipulation to being able to put down the 3% on the standard is that you're first-time home buyer?
First-time home buyer.
That's correct. Yep. That's correct. The Home Ready and the one that we're going to talk about next, which is Freddie Mac. We'll go ahead and move there. Neither of these require you to be a first-time home buyer, but the 97 standard does.
Yep.
So Freddie Mac Home Possible, there's not a whole lot of difference between the Home Ready and the Home Possible. Josh, why don't you talk a little bit about the nuances between Fannie Mae and Freddie Mac and why is there two? And
well, just the differences between the two agencies, they're almost non-existent. For some reason, the government has two government-sponsored entities. They both write guidelines, they both securitize and ensure federally quasi-federally backed mortgages. And for the most part, their guidelines overlap 97, 98%. It's not really beneficial for you guys as borrowers or potential buyers to know what the differences are, but they're generally pretty minor. They do both have different automated underwriting engines. So sometimes you'll have a borrower that doesn't get approved by one, can get approved by the other. They both, because of those algorithms, issue appraisal waivers differently. On a minimum down or a 3% down, you're never going to get an appraisal waiver, so it doesn't matter. But on our end, it's important that we have access to both and know the subtle differences, because 9 times out of 10, they don't matter, but when they matter, it's pretty important. Now, like you said earlier, Scott, we used to love Home Ready and Home Possible when California home prices were lower and we could go to 100% of the area median income. When they peeled that back, I literally have not seen a client eligible for it in probably 2.5 years. So Mia, Chad, you guys know the differences between Home Possible and Home Ready? Any important or significant differences that folks watching at home should know?
Not Freddie Mac and Fannie Mae, there are more differences. I don't think that there's too many between their version of Home Possible and their version of Home Ready. I think they're pretty equal there. There may be a difference, and Chad, maybe you know that too, on 2-unit properties. And I'm going to have to look that up real quick, but I think there's a 2-unit property with a Home Possible that you can still get in at a minimum.
So they're definitely used to be multi with Home Possible. Then I think they peeled that back, and then I think they added it again.
Freddie Mac will allow on a fixed rate mortgage up to 4 units, but it's not going to be 3% down. So you can
right.
Yeah, it's 5% down. Another cool thing about these products, so the Home Ready and the Home Possible are what these agencies call their affordable lending products. And one of the cool features of that is they will allow, if you're using a community second, which is like a municipality second from a mass housing or a state housing finance agency, they'll both allow you to go up to, I think, 105% of the loan amount to cover closing costs and down payment as an assistance program, as long as it's an eligible assistance program. So it is possible to use a local, they call it an affordable second, which it needs to meet certain criteria, which is normally a city sponsored program, a state sponsored program, for first-time home buyers, typically, even though you don't have to be a first-time home buyer. But that's another really cool feature with those affordable lending products, is that you can stack assistance on top of that. And we'll probably do an entire episode on buyer assistance and what that means. So let's go ahead and slide right into standard, traditional, conventional financing.
And the big thing to know with this, Scott, I mean, it's no different than putting 20% down, only you will pay a slightly higher interest rate because there's a little more risk to the lender. And you're going to have mortgage insurance to insure the lender against that risk because you don't have your big down payment. So this is probably really just a discussion about mortgage insurance and the myths and misconceptions around mortgage insurance. I have people all the time, they go, oh, I don't care. I'll put 20% down. I'm not paying mortgage insurance. And it's a little known fact that for mortgage insurance, it's a sliding scale. The more you put down, the cheaper the mortgage insurance is on a conventional loan. And the higher your credit score goes, the lower the mortgage insurance is. And if we add multiple borrowers, that also decreases the risk because the lender looks at it as we no longer have a single point of failure. If Scott owns by himself and he gets sick and loses his job, we got no income. If Scott and his wife own, well, now we still have one income there. So all of those things come into play. So if we have borrowers with high credit score, 760, 770 credit score, and they're putting 5 to 10% down as a husband and wife, 2 borrowers of any type, it's really not a big difference in terms of what you're paying. Sometimes these premiums are as low as 0.2, 0.3%. So even when we have clients that have 20% down, that numbers never lie presentation that we want to show them two options, I still want to show them a 15% down or a 10% down, because cash is king. Being able to hold some money back and have it available. Oftentimes when clients see how low cost the mortgage insurance can be, they'll just say, yeah, you're right. I mean, I don't care about $120 more in my payment when I could have $80,000 more in the bank. That's a nice cushion and a level of comfort there. So now on the flip side, if we have a borrower that has a 660 credit score and they're a single borrower and they're putting 5% down, that mortgage insurance does get really heavy. And that leads us back to that conversation where we're generally looking at the FHA loan at that point, because the combination of the rate and the mortgage insurance is going to be lower. But besides that MI conversation, you guys, what else do you talk to your borrowers about when we're considering the difference between 20% down and lower down conventional loans?
I think you just hit it right on. I mean, it really comes down to FICO there. I mean, if somebody does have a 20% down payment and it does pop approved with a 650 FICO, they're not going to have PMI. So at that point, their rate is going to be hit with adjusters. But we might be looking at that as something that makes sense, or comparing to just giving the options, looking at the FHA. Obviously, if we gave the option with 5% down, it might not even pop approved with a 650 or 660 FICO. So, but I think you nailed it when you said, two borrowers, high FICOs versus low FICOs, or even somebody with a lower FICO, 660, 670, but then you have somebody with a 780 FICO, that can dramatically tighten up and reduce the PMI. I saw it significantly recently when we had like a 680 and a 780. And it was just, I was like, wow, it's really cheap.
It's funny that you say that. I had that yesterday that I was like, oh, crap. These guys can put 20% down. They want to put 10% down, but one borrower had a 678. And I'm looking at it going, he's going to choke when he sees how bad this MI is. Yep. Well, his wife has great credit. So the combination of the two of them, it wasn't wonderfully low, but when he looked at it, he goes, it's not all that bad.
Yeah, I was the same thing. I was expecting like $350 in MI, and it was like 160. I was like, oh,
Again, that's that experience, right? You having options. Your options are always determined by the experience of the loan officer you're talking to.
And I'll mention that we have to shop those PMI companies, right?
That was exactly what I was going to say, Chad, because how often do you see we get shopped all the time? It doesn't matter. I could be universally regarded as the greatest loan officer on the planet. I'm still getting shopped. No one just trusts your title. They're going to call. And so they'll show me numbers and I'll look and you're like, where did these numbers come from? So tell them just a little bit about how much it can vary from one mortgage company to one mortgage insurance company to the next.
Yeah, significantly. I mean, you could see $100 depending upon the purchase price or the loan, the loan amount, but you could easily see $100. We're shopping 6 or 7 companies, and that's what my team does at this point. If I have to jump in and help, but my team is just trained as to be shopping it in the pre-approval stage, but then shopping it again, because at different points in times, different PMI companies will choose to associate a different level of risk to that FICO bucket. Because of course adjusters are typically based upon buckets of FICOs from 20 points, so 660 to 679, for example. And for whatever reason, they will pick and they will change those buckets a little bit. So even if it's just changing it by 0.05 on a $400,000 loan, it can make a $20 difference. So we're always, shopping that in the beginning and then through the process to when we're locking a rate.
And the important thing to note is if you don't do that and you submit your loan to underwriting, you don't say, hey, I want to go to MGIC or I want to go to Radian or I want to go to Essent. They have the best terms on this. The underwriters are going to go the path of least resistance. Which website is easiest for me? Which button can I push the fastest? And it may be the best. It's more likely to be $20, $40, $80 more a month. And they went that route because no one told them. It's not their job to stop and shop it. Your loan originator needs to be doing that for you. And hopefully when they're comparing it on the front end, they're doing that. I'll tell you, I see numbers from other loan officers that we get to win the deal by default because they were too dumb to go look it up and just threw a number in. And you run the numbers and you're like, it looks like their MI is really high. We have a special relationship over here with these lenders or these MI companies that we shop, and it gives us a leg up. I mean, we do have really good rates and we do have really good relationships with multiple mortgage insurance companies, but it's just important that you're not dealing with someone new that doesn't know their way around this. There's a million ways to screw up a deal, but only a few ways to do them right.
I would just back that up with like it's a laziness, I feel, and it's the just like back to the 3% Fannie. People don't even know it exists. They just kind of associate a 3% down payment with Fannie or Freddie to be income limited. And so a lot of people don't even know about that product. And so you win that deal just because of that knowledge, and you better serve that client. And then, same scenario right there. For whatever reason, I don't know. Maybe they're just fast, trying to get the pre-approval of the other lender, and they don't take a little bit of time to shop the PMI up front. And then that's when we come in and we can show, well, hey, look, this is our PMI.
Yeah, and Mia, you had kind of mentioned that sometimes maybe they have a 5% down, but if they use the Home Ready, then maybe they can use some of that down payment to buy out the mortgage insurance.
Right.
So then they don't even have the mortgage insurance, and there are other benefits. Now that really takes a master to do those numbers and make that stuff make sense. I know Josh isn't a huge fan of paying things up front because you never know what the future is going to bring, but sometimes those scenarios make sense. But again, you lay out all of the options to the client, and
right.
you let them choose the one that makes the most sense for them.
The times that those would make sense, the rates on PMI, on single premium upfront PMI, get great when you're doing Home Ready because they're so reduced that your payoff or your break even is going to be in 18 months or 24 months. When you've got a short payoff or break even period, that's when it starts making sense. Or if you're dealing with someone who's got a higher debt ratio and you need to get rid of that PMI in order to qualify that person. And just like Josh was saying earlier, you're not going to get that with a Rocket or a Quicken or anybody like that because they're taking orders and they're flushing you through the system. They're not thinking about you. They're not thinking and looking at your debts and looking at how we're going to make this work. They're just doing their job, crunching, just putting it through.
Well, yeah. Here, just to put something in context and to somewhat defend the cubicle dwellers over at the big national lenders, they close less than 1% of the leads that they receive. It is truly kill them all, let God sort them out. So as an originator there, your job is to get people on the phone, get an application out of them, and get them to send in their information. It's not to give them options. It's not to advise them. It's not to help them get an optimal loan. It's to get them committed and then hand it to someone else who hopefully can figure out which program you have to close it. So you kind of want to talk to, if you're talking to someone, you're talking to a person in a call center, hey, how many new people do you talk to every day? And if they're telling you, I get about 8 to 10 new ones, there's no world. If you told me I had 5 new leads, 5 new potential clients coming in a day, I would run in panic because you can't talk to 25 people in a week and have the level of conversation that you need to have and go to the depth that you have and give them the advice and time that they need. So it really is important that there's a balance there. The person that's doing no business probably doesn't have the experience to help you in the way you want and need to be helped. The person that has a million loans being dropped in their lap, or there are a million potential loans, none of them are all that important. They're just trying to work through it as fast as possible.
Right.
Yeah. All right. Well, some areas like Josh, you in California, conventional has what they call high balance. Do you want to explain that?
So anytime you get above the standard balance limits, and this is funny because I always forget what it is because we rarely come across ones that low. Is it 647,200? Is that our magic number this year?
647,200.
Okay. It only took till the 1st of June for me to memorize this year's number. So 647,200 is 99% of the country is the maximum you can do with a Fannie Mae or Freddie Mac loan. In high cost areas, which is most of coastal California. You're getting some weird inland places. Jackson Hole, Wyoming has it. Some little pockets of Tennessee have high balance loans. But in essence, you're able to use Fannie Mae, Freddie Mac options up to 150% of that limit, which is over $950,000 this year. So closing in on $1 million. The biggest difference is you lose all of the 3% down options. You have to go to 5%. The double big difference is the government, in their infinite wisdom, said that they wanted to help support more lower income buyers, so they were going to tax the people that were buying these expensive homes. So if you put less than 25% down on a high balance loan, you're going to have an additional 1% loan level price adjustment. Most people don't want to pay an additional 1% or 1 point out of pocket, so they're going to take a 0.25% higher interest rate on that loan. So there's really no good
minimum $6,472.
Yeah.
Right.
Yeah.
It's
a crazy number. And again, this is why people in the government should never be trusted to do anything with numbers, because they said, these rich people can afford it. They'll happily pay that. We'll have this extra money and we'll subsidize the loans for the cheaper people.
That's not even a one-bedroom condo in Orange County, California.
So the reality is people are just backing away from these loans. Less of those loans are being done. We've already had interest rates increase 2.25% since January 1, and now we have another 0.25% tax on top of that. So you're 2.5% higher for these folks than where they were in January. So the reality is there are some options. For us, we have a portfolio lender here that only does 8 counties in Southern California, so they don't cover the entire state, but they basically mirror the Fannie Freddie guidelines and don't charge those loan level price adjustments. So you want to check, you want to shop around, talk to a couple different lenders, see if they have access to any unique programs outside of that if you're in a high balance area. But it's still an awesome program. You're still following Fannie Freddie guidelines. It's just not as good as it was. With rates up, there is some pressure on the Federal Housing Finance Authority, which dictated this change to sort of repeal that and roll it back. I don't know if it's going to happen. I sure would hope so. I know some friends of ours and some smart people are putting some pressure in Washington, D.C. to make that happen. But I would still say, are you better off doing a 5 or 10% down high balance purchase or waiting until you have 20, 25% down? Absolutely, for a couple of reasons. One is we don't know that it's going away in the future. And unless you put 25% down, you're paying that point. And even at 25% down, I think it's still like 0.625. So like more than a half of a point cost. So the same options are available except for the 3% down. The automated underwriting engine, very similar. It's a black box. We don't know the exact algorithm, so I doubt that it's any tighter than the lower priced homes. So all the same benefits. Mortgage insurance is going to be there, but the same discussion we had with mortgage insurance on standard balance loans, those are the things that you want to look at. Just know that the high balance loans have gotten more expensive since April.
And let me ask you a question, actually, Josh. So for me, I don't do a ton of loans. My average loan amount is $300 and change in Worcester County, Central Massachusetts. I'm only 50 miles from Boston, right? So I do have some clients out in those counties where I am up in that price point. The only real benefit I see is really that 5% down typically, and potentially lower FICOs. And I know we'll talk, I'm sure, about jumbo, but jumbo has higher FICO limits. So if somebody has a 690 FICO, somebody has a 690 FICO and they only have 5% down or 700 FICO. I know it's a little stricter with Fannie even, I think, but that's where I see the benefit is like that 5% down.
Well, the other big difference, because this is a good leeway right into jumbo. In the rest of the country, if you're using a conventional financing, you're already going to be above FHA loan limits. Anything over, so $647, $201 is considered jumbo. But the real big difference between a high balance and jumbo, there's a few differences, but the big one is reserves, right? So it's definitely down payment. You're not going to get that 5% down payment, but the jumbos typically, as soon as you go into jumbo territory, higher down payment, and you have to once the loan is closed, you have to have X number of months in the bank, depending on your loan amount and right. You guys.
Yeah, and most of them are in the 6 to 12% range or 6 to 12 month range. So let's say on a high balance loan, you have a $6,000 monthly payment. Let's even say the low end, $4,500 monthly payment. 6 months means we need to have another $25,000 in reserves. And it can be in a retirement account, it can be invested. It doesn't have to be liquid sitting in a checking account, but it could be a little bit of an impediment. And Chad, I don't know what you're seeing in general, the 10% down and even 15% down jumbos, you're paying a pretty healthy premium on the interest rate on those, in addition to having to have the better credit and the reserves. When I pencil them out, I generally, for us, we still see the high balance being better for someone even in the 10 to 15% range, unless they have a spectacular credit score and a bunch of reserves.
All right, guys, real quick, I want to, this is relevant. We had a question here from LinkedIn. I believe this is in this question is for Josh. You were talking about the special loan program. Best bet is to reach out to Josh, and because it's kind of a proprietary program, right? It's not widely available.
It's not. It's only available through our company. It's a portfolio lender that only lends through us in 8 counties here in Southern California. So if you're a lender, you won't be able to get access to it. If you're a borrower wanting access to it, absolutely reach out.
Sure. Okay. So I can connect you with Josh. It's Bywise Mortgage in Huntington Beach, and
email's easy. Just josh@bywisemortgage.com.
And I think, Josh, how do we show your name? I guess we probably got to pull the banners off and then your email address.
No, it'll show both. I just always forget what we're doing with this. We have show display names turned on, so I don't know why it's not.
Yeah, I think it's the banners.
It was on there when we started.
I think it's the banners.
There it is.
There we go.
So josh@bywisemortgage.com. So sorry to derail the conversation, but I know that's a super unique program, and if you fit into it, then you want to know about it. Anything else on jumbo? I guess we can't really go into jumbo. You can do 10% down on a jumbo, but if you don't have to, like the terms are pretty nasty, right? Did you already cover that?
Well, he did. I'll just answer that though, Josh. We don't have, again, out this area, I don't have as many opportunities to do the higher Fannie Freddie up to 150%, the high balance. So I'm stuck with I'm stuck with jumbo. So I've got 2 jumbos going right now that are not in a high balance area. And so they have to go jumbo, and they're both putting down, believe it or not, only 10%. And so for them, it was a no-brainer to go with an 80-10-10. And so what that is 80 LTV at a pretty darn good rate. It's not the best because some of those jumbo lenders don't allow for the 80-10-10, the total 90% loan to value between 2 mortgages. But we got a couple that do. And one in particular really does a great job and offers. And they actually follow Fannie and Freddie guidelines in a way that some jumbo lenders don't do, like a deed in lieu of foreclosure. This one says 4 years. That's what Fannie and Freddie, we go by Fannie guidelines, but just about every jumbo lender actually considers a deed in lieu of foreclosure kind of like a foreclosure, which requires 7 years. So there's all these little intricacies, but I do have a good channel for an 80% loan to value on the first and a 10% loan to value on a second, so that they only put 10% down out of pocket.
As we kind of bring this thing in for a landing, if you're watching this, as a consumer, whether it's your first home or whether it's your second home, it's probably been a few years. These guys, you can tell these guys are experts. We've been rabbit holing in all these little scenarios, and you can rattle off, well, if this and that circumstance exists, then we can double this, divide it by this, and add this, and we can make this work, and we can make this figure out. And that's because you guys are experts, because you really, really care. We talk about big box lenders. the most important word there is box. A lot of these lenders that you'll find on TV commercials or on the internet, if you type in mortgage loans, because they spend billions of dollars in advertising, they have a box. And it's a very small box. And if you don't perfectly fit into that, they are more likely to tell you no than they are to tell you, well, we can't do it, but maybe you can find somebody that can. And we all work for different companies. We have access to different resources. We have decades of experience. And at least here on the Find My Way Home Expert Network, if Chad can't figure out a deal or he has some sort of restriction, he might say, you know what, why don't you check with Mia, because she might have access to a special program and maybe run it by her, or vice versa. And that's something that we that's something that we do all the time. Collectively as a community, we are committed to working to tackling the stuff that's outside of the box, listening, and gosh, we hate to take no for an answer, right? We're like, yeah, let me do some reading.
This sits on my desk. So my whole team, this is how we work. Every loan, all the people that we talk to from Find My Way Home, that's why I love dealing with people who are looking on your website, because 9 out of 10 times they've already been through the ringer. They've been told no, and they're not quitting either because they know there's something better out there. And I love dealing with the people that find you on Find My Way Home.
Remember, Mia, it's no longer Scott's website. It's our website. We're all members. We are all members. It is our website. It's Chad's, it's yours, it's mine.
And
Scott shared.
A beautiful thing.
And we got Chad out there on the East Coast clocking in close to 9 o'clock. It looks like it's your bedtime, old man.
Yeah.
And, but you're committed to coming on here and sharing your knowledge. So this is our website, findmywayhome.com. You can, if you're watching us, we have comments from Facebook. We have comments from, actually, we got a little comment here. So somebody thought we did a great job. So that's what we do this for. We really appreciate it. You can find any of these guys on findmywayhome.com. You can search by state, but most likely you will see them if they are licensed in your state. You'll see it on any page that you're on the website. So, well, guys, thank you so much for staying up late. We had some great questions. We had some good attendance. It seems like we helped a lot of people here tonight. So thank you so much for being a part of the community and caring so much. And you did a really, really good job unpacking this topic. So thank you very much.
Thank you, guys. Have a
Thanks
great
for having
night.
us.
Great to see
See
you
you guys.
Okay, guys. Bye.
Bye.